Warren Buffett, John Templeton, Michael Burry, three investors that made their fame and fortune from betting against the crowd.
But contrarian investing is easier said than done. It feels uncomfortable and it makes your stomach turn. Who was investing in oil when it traded in negative territory or buying shares in Qantas when COVID hit?
Bitcoin is the talk of the town right now, but nobody wanted to know it when FTX scandal erupted and the price was below 20,000 bucks.
In this video, we're asking our guests to dial up the pain and share contrarian plays catching their eyes as we head into 2025.
Been a bullish year, everything's been running. There's probably not too many bad ideas left out there.
Yeah.
What's been unloved? What's a contrarian idea that you like for 2025?
Yeah, well, we're known to love our contrarian plays. So this is one I think that's somewhat ultra contrarian, but we're going to go with it, and that's Helios. So the ticker is HLS. It is the second largest pathology company in Australia. They've got about $1.3 billion of revenue. And so through COVID, they were obviously a massive beneficiary. You had COVID testing volumes at all-time highs. As those volumes have normalised, you've seen their earnings collapse. And it's been the case across...
It's not a word we like to hear when we talk about stocks.
I know, but it's been the case across the industry. I guess this is what the opportunity is. So it's just recently de-geared the balance sheet. It's sold its imaging business for 800 mil. So it leaves the business with about $400 million of net cash. If you add to that the franking credits, which are obviously value, then the market's only ascribing a third of its revenue in value. So it's only valuing the business at $400 million today. So despite the checkered history, despite what's happening out there, I think earnings can improve dramatically. They're guiding to a better second half, and there seems like a lot of value in this business at these current levels.
You're probably going to laugh when I say that it's ARB, because ARB has been, historically very well regarded. It's a high quality business. Where I stand differently on this one is that I think they tend to be genuinely good performers. And people are really missing that while the Australian market might be seeing a little bit of weakness right now in the short term, there's a huge story going on in the US, where just this last year, they've made some pretty strategic investments in channels to market so they can increase their sales over there. They've invested in new management who are doing a great job. They're investing in R&D facilities over there so they can kind of generate product just for that market. And I think they've been great allocators of capital over time. So while it's a little bit soft at the moment, I think it should come good through 25.
So contrarian stock we like for 2025 is a company we think that's just gone through a lost decade. So this is a fantastic growth company trading at deep value price, and it's life insurance. Now what's happening, a company we really like, Corebridge, is actually spun out of AIG in 2022. They're one of the leaders in life insurance and also annuities in the US, and they're able to basically invest these longer term maturing bonds that are rolling off from lower rates. And for every single month or quarter that rates stay higher, you can just imagine their portfolio yield is increasing. But also for the entire US annuity sales that we're seeing in that market, we've actually seen those double in the last 4 years. So if rates stay higher, we think this is a company that used to trade pre-GFC in a normal interest rate environment around 12 times, and it's actually stuck in this 7 to 9 times. So earnings could double basically in the next 5 years, and we think that we're going to see potentially even a 50% uplift in valuation.
Yes, there's a stock in our portfolio which we like, which has unfortunately kind of had a profit downgrade and retraced a lot recently. The stock is Doug Technology. It had an amazing run coming out of COVID. The stock was up about 400% on really strong earnings growth. And just for reference for what it does, it has high performance computing data centers around the world, and its primary use case is processing seismic data for oil and gas companies. So the revenue is slightly more lumpy given it's effectively an oil and gas services company. We think that this is a fantastic founder-led company. We think that the lumpiness is more a timing issue than anything structural. In fact, the company came out and said the pipeline has never been bigger. They expect it to convert in the second half of this year, and they're very excited about opportunities in the Middle East, as well as opportunities for other segments of the business in immersion cooling and HPC mobile units. The business is currently being valued by the market at only 6 times EBITDA, and this is looking backwards, so 6 times the normalised EBITDA that they printed in FY24. And we think this is far too cheap, and there's enormous optionality in the other parts of the business, and all it will take is one Middle East win, one win in their immersion cooling business or the Doug Nomad HPC business to really trigger a significant re-rate here.
Yeah, so a stock that we think's been overlooked by the market is Servcorp, and that's the ticker SRV. So Servcorp's a provider of flexible workspace solutions. It's effectively a more traditional and profitable version of WeWork. What's really changed in this business since 2019 is that revenues are expected to be broadly flat over the 5-year period, but what's happened is profitability has been able to double. If you look at the business at the moment, it's about a 500 mil market cap and about a quarter of that sitting in cash, so about 125 mil of cash with no debt on the balance sheet. They've got guidance in the market to deliver 65 mil of profit before tax, which is about 15% growth on last year. And trading on those numbers, it's about 9 times PE, or about 7 times if you back out the cash. The CEO, he's about 80 years old. He owns 50% of the business, started it 50 years ago, and he's bought stock 3 times on market in the last month. So we think there's more there in Servcorp.
We're leaders in contrarianism, so I'm going to run with Seek. I feel as though potentially the buy side isn't appreciating it as reflected in the share price at the moment, and they're just too focused when it comes to the jobs market, whereas already we're starting to see that the jobs market is holding up better than expected. Then you've got the cost base too with this stock. For us, they've just coming through the peak of their unification and the benefits that might come through on that. You're also though seeing the potential for the growth fund, which to us is not valued by the market, and they're coming up to the period of time where that's got to be realised, otherwise the likes of the founders aren't going to go get their benefits and their performance fees. So I think there's a few components on that front where that remains a name that is not yet being appreciated, but hopefully will in time.
Richmont is an interesting one. So they own Cartier, the jewellery and watch brand, and they're benefiting from a market shift from unbranded to branded jewellery. They're also divesting their unprofitable e-commerce business, which should make them more profitable and focused going forward. And they're in a better place to manage their inventory during this downturn than they have been in previous ones.
Yeah, so something that's certainly a bit unloved, and we've worn some pain on it over the past 12 months is land and marine tourism operator Kelian. Had a bit of really quite a torrid 2024, some real own goals, capital spending discipline, also market communication. But we think that the market's really thrown the proverbial baby out with the bathwater with this stock. The core Australian bus business remains a fantastic business. It's high returning, it's capital efficient, infrastructure-like in nature. You've got these long-term, stable, recurring inflation-protected revenues. That business is actually still performing well. And the thing they acquired in the US, All Aboard America, also is actually performing ahead of expectations. It's really been clouded by some of the noise that's been happening at the group level. So we do think heading into 2025, we know that there's a strategic review going on. The board and management are being accountable. We expect a streamlined Kelian, a more cash generative Kelian, and certainly a Kelian that trades on more than its current level of around 6 times EBITDA.
There's probably not many people that have spent much time in Myer in the last 6 months, but I've been in there twice. Probably the secret sauce that Myer has is 7 million Myer One customers, which have those little black and white cards that 15, 20 years ago, your mum and dad might have had one in their wallet. They still exist, and I think on last count, there's more than 4.5 million that are active. Now that loyalty is pretty amazing for a store that's potentially lost its way in terms of what does it sell, what does it stand for. The other secret ingredient that Myer recently has is a new executive chairperson, which is Livia Worth. Now, she was one of the architects of one of the most successful loyalty programs at Qantas in the last decade. And she's come in there with that loyalty background to put a fresh set of eyes on how they can transform those really loyal customer base into buying more from Myer, and also look at productivity improvements and opportunities. Now, the third leg in the story about why it's interesting is they've recently announced a deal to acquire a number of private label brands off Premier. Now, they're brands like JJ's, Just Jeans, Dottie, for example, Jackie E. So with that acquisition, Myer has indicated that there will be potentially $30 million of synergies in the first instance. But it's going to become a pretty big business, sort of $4 billion of revenue and maybe $150 million of EBIT. And we think that there's a lot of opportunities for Olivia, assuming the merger goes ahead and is approved, to look at the smarts that are within Premier and potentially introduce that to some of the brands that are sitting within Myer itself.
Look, we think the market's way too bearish on actually both oil and iron ore. Iron ore has obviously been associated with the China trade. The market's been bearish on China and China growth. We think the market's a little bit too bearish, at least in the immediate term. So from that end, we think there's at the early part of the year, you tend to see supply interruptions, whether it's Australia or Brazil. There is a lack of new growth coming through. So there are a few names that we do like. So in iron ore, we like Champion Iron, listed here in Australia with assets in Canada. They are actually continuing to grow their production. They're working hard to build out their production of very high-grade iron ore. We think that gives you a unique advantage in a marketplace which is desperate for high-grade units. They're cutting their costs. They achieve a premium for their iron ore, and so we think that's at a cheap valuation a great way to be. And in oil, look, it's a range trading commodity. To be fair, you do have an overhang of considerable OPEC spare capacity, but we think the market's way too bearish on that. We think the OPEC nations will continue to be very constrained in their supply. We also think there's way too much optimism with regards to new supply coming out of the US under Trump administration. In the oil patch, we invest globally. So in Australia, we like Karoon. It's beaten up. No one's liked their acquisition of an asset in the US. They've had some operational challenges in their Brazilian asset, but we think they're through the worst of that. And again, trading at a ridiculously cheap multiple and now starting to buy back their stock quite aggressively. In the US, we like EOG, which is one of the leading unconventional producers of oil and gas in the US. Net cash balance sheet, buying back $5-6 billion worth of stock every year. It's actually a no-brainer. That is a sleep at night oil and gas name.